When people hear phrases like global debt, reserve currency, central bank gold buying, and de-dollarization, most of them make the same mistake. They turn it into a movie. They imagine one dramatic night, one emergency speech, one currency crash, one market halt, one front-page headline, and then the whole world waking up poor the next morning. That is not how the largest wealth shifts in history usually work. They work the way rot works in a beam. The paint looks fine for a long time. The house is still standing. The owner keeps telling himself that because the structure has not failed yet, the warnings must have been exaggerated. Then one day weight is applied in the wrong place, and what looked solid gives way much faster than common sense expected. I have spent most of my life around capital, and one lesson repeats over and over. The most dangerous point in any cycle is usually not when the numbers first become extreme. It is when people become emotionally adapted to extremes and start treating them as normal. That is where I believe we are now. Global debt has moved past levels that used to sound like science fiction. The world is carrying more than $300 trillion of debt. The United States has spent years expanding money and credit on a scale that earlier generations would have regarded as unthinkable. Interest costs that once looked manageable now consume real fiscal room. And at the same time, central banks that publicly speak the language of stability are privately acting like students of monetary history. They are buying physical gold, they are exploring alternatives, they are reducing blind dependence on a dollar system that once looked untouchable. Those are not random gestures. They are signals. Fe file a site, fe turn 20 file 0 fe. I do not mean signals in the sensational sense. I mean them in the way an insurer studies probabilities, or the way a good poker player watches what people do with their hands when they are not performing for the table. A great deal of modern financial commentary is theater. It exists to make complexity feel exciting, immediate, and easy to monetize. But wealth is usually moved by mechanism, not by drama. If you want to understand where the world may be going, you have to stop asking, what shocking event is about to happen? And start asking, what structure is weakening? What structure is forming? And who is quietly repositioning before the public notices? That is the frame I use. And when I look at the long record of empires, currencies, and financial centers, I do not see randomness. I see a pattern with different costumes. Rome wore it, the Dutch wore it, Britain wore it, the United States is wearing it now. Not in identical calendar time, and not with identical institutions, but with the same moral rhythm. First comes real strength, then comes confidence. Then confidence mutates into entitlement. Then entitlement gets financed. Then the financing becomes a substitute for discipline. Then the system that once created wealth begins consuming the trust that supported it. That is the entire drama in one line. Most dominant powers begin honestly enough. They build something useful. They create order where there was fragmentation. They offer security, a common unit of account, a legal structure, a trade network, a settlement medium, or a financial innovation that lowers friction for everyone else. At the beginning, the privilege is earned. It is not a trick Rome, imposed order over enormous territory and made trade roads law, and taxation legible across lands that had previously been scattered and tribal. The Dutch created a level of commercial sophistication and market organization that seemed years ahead of the rest of the world. Britain built an imperial, industrial, and financial network so dominant that the pound became the bloodstream of global trade. The United States emerged from the Second World War with industrial supremacy, military supremacy, and a currency framework tied to gold, later reinforced by oil settlement and an unrivaled treasury market. Every one of those systems deserved trust in its early life because each one produced genuine utility. Fe file site fe turn 20 file 0 fe, that is stage 1. I do not care whether people call it foundation, consolidation, primacy, or establishment. What matters is that the dominant power becomes the rule setter. Everyone else begins playing a game whose scoreboard, language, and enforcement are defined elsewhere. That arrangement creates enormous benefits for the center. Trade expands. Debt becomes easier to issue. Capital seeks your institutions rather than fleeing them. Your currency is held not because people love your flag, but because the system around your currency feels like the least inconvenient way to conduct serious business. Then comes stage 2. And this is the stage people always misread because it does not feel dangerous while you are inside it. It feels magnificent. The dominant power can borrow more cheaply than others. It can run imbalances for longer. It can fund military commitments, domestic promises, rescue operations, and consumption levels that weaker countries could never sustain without immediate punishment. Its currency does not collapse because demand for the currency is still real. Its markets remain deep, its debt remains liquid, its elites begin interpreting privilege as proof of permanent superiority. This is where the psychological break happens. They stop saying, "We can do this because we are trusted," and start saying, "We are trusted because we can do this." That is how discipline flips into complacency. Rome did not wake up one morning and decide to become unserious. It simply discovered that debasing silver was easier than honestly pricing empire. The denarius lost purity over long stretches of time, and by the time the damage became socially obvious, the currency had already been hollowed out. Merchants adapted, prices rose, the middle layers of society took the pain first. Political instability followed monetary instability because public trust is never purely financial. Once the ruler starts shaving the coin, the citizen starts questioning everything else. Fay Philocite Fay turn 20 file 0 Fay. The Dutch case fascinates me because it happened with such speed relative to Rome. The Dutch Republic built one of the most sophisticated commercial systems the world had ever seen. The guilder, Amsterdam finance, the VOC, the banking architecture, the trade routes, all of it looked almost invincible at its peak. Then military pressure, debt expansion, and competitive challenge from Britain began tightening the screws. The Dutch did what privileged systems often do. They assumed the center would remain the center because it had already become the center. They confused first-mover brilliance with permanent structural immunity. Capital is less sentimental than that. It migrates. Fay Philocite Fay turn 20 file 0 Fay. Britain followed the same emotional script with a different accent. Sterling became the foundation of global trade because Britain genuinely had the navy, the industry, the legal reputation, and the imperial reach to support it. Then came overextension, war financing, industrial rivalry, and the desperate effort to preserve appearances after the underlying balance had changed. Maintaining parity with gold when the structure no longer supported it was not strength. It was denial in formal clothing. By the time Bretton Woods settled the post-war order, the dethroning had been in motion for years. The ceremony came later than the reality. That is another rule worth remembering. Formal recognition of a wealth shift usually trails the actual shift. Fay Philocite Fay turn 20 file 0 Fay. That brings me to the United States. I am not in the camp that says America is no different from every empire that came before it. It is different in some ways. The scale of its capital markets is different. The flexibility of its private sector is different. The role of the dollar in trade, reserves, collateral, and sovereign finance is different. Its innovative base is different. Its geography is different. Its alliance structure is different. But difference is not immunity. And the most expensive phrase in financial history may be, "This time the old rules do not apply." After the Second World War, the United States built a monetary order so dominant that dollars were treated almost as a second layer of sovereign reality. They were held because they were backed by gold at $35 an ounce. They were later held because even after gold convertibility was severed, the broader architecture of American power was still so overwhelming that faith migrated from the metal to the system. Manufacturing, military strength, legal enforceability, and later the petrodollar arrangement all reinforced the same message. If you needed to store value, settle large transactions, or manage reserves, the dollar system was the deepest pool available. Fay Philocite Fay turn 20 file 0 Fay. That was real power. But once Nixon closed the gold window, something fundamental changed. The measuring stick was no longer anchored by convertibility. It was anchored by confidence alone. Confidence can carry a very long way when the surrounding structure is strong enough. In fact, it can carry much farther than most people think. That is why people who predict immediate collapse every time a central bank expands its balance sheet usually end up looking foolish in the short run. But confidence without external discipline also changes behavior. The easier it becomes to finance deficits, the less political pain is associated with promising more than you collect. If your currency sits at the center of global reserves, you can export a portion of your mistakes. If your debt market is the deepest in the world, buyers keep showing up. If your military protects major trade routes and your alliances reinforce settlement habits, other nations may dislike your behavior while still using your system. Privilege can therefore delay consequences. Delay is not cancellation. The United States has expanded debt from a few hundred billion in the early 1970s to well above 30 trillion. Today, annual deficits that once would have triggered national panic are discussed with a shrug. Interest expense has climbed toward levels that compete with the largest line items in the federal budget. At the same time, a great many Americans do not feel correspondingly richer in a durable sense. That mismatch matters. If a borrower keeps adding obligations while the underlying public feels less secure, less buffered, and more resentful, the issue is no longer simply one of scale. It is one of quality. What exactly was purchased with the borrowing fay-falicite fay-turn? 20-file-0 fay, that is the question I ask in business. I ask it in household finance. I ask it in public finance. Borrowing to buy a productive asset that compounds your future earning power is one thing. Borrowing to preserve a pattern of promises you are unwilling to price, honestly, is another. A balance sheet cannot be judged only by size. It must be judged by what the obligations financed and what they now demand in return. This is where the modern American discussion becomes so evasive. People swing between childish optimism and childish collapse talk. One side says the dollar has no rival. America can always print, and technology will save everything. The other side says total destruction is imminent and paper assets are all doomed. Neither position helps much. I prefer arithmetic and incentives. If a nation keeps adding debt faster than it adds productive capacity, and if the carrying cost of that debt rises, then more and more of tomorrow's choices are pre-committed to yesterday's promises. If that same nation also uses its currency system as an instrument of geopolitical discipline, then every reserve manager on earth starts asking a question that matters more than public rhetoric. Not, do I like America, but how much dependence is prudent? That is a colder question and therefore a more useful one. When Russian central bank reserves were frozen after the invasion of Ukraine, the policy debate took most of the public attention. What mattered to me from a monetary perspective was the lesson taught to every other reserve holder on earth. They watched a supposedly safe claim inside the Western financial system become politically contingent. Once that happens, the content of the specific conflict matters less than the precedent. Reserve managers are paid to think in precedent. If one country's access can be impaired, then all countries must at least consider the possibility that excessive dependence on one reserve architecture carries strategic risk. Fay-falicite, fay-turn 20-file-0 fay, and almost immediately, the behavior began to confirm the lesson. Gold purchases by central banks accelerated to the fastest pace in decades. Countries that had once treated physical metal as an old relic began treating it again like serious reserve insurance. Trade settlement experiments outside the dollar expanded. Saudi Arabia showed greater willingness to discuss non-dollar oil settlement. China kept building alternatives. Russia, Brazil, India, and others became more vocal about reducing dependence on Western financial pipes. None of this means the dollar is about to vanish. That is not the point. The point is that unquestioned dependence is being replaced by active hedging. And once hedging becomes a habit, history tells you the center of gravity has already begun to move. Fay-falicite, fay-turn 20, file 0. Fay, this is what stage 3 looks like. It does not announce itself with trumpets. It begins with reserve diversification, with settlement adjustments, with bilateral arrangements, with language changes in ministries and central banks, with quiet vault activity, with shifts in who buys what kind of debt, and why publics do not usually notice stage 3 because everyday life still functions. The supermarkets are open, the stock market still quotes prices, credit cards still swipe, pensions still produce statements. Television still treats the old measuring stick as if it were sacred, but beneath that surface, incentives are changing. A reserve currency enjoys what some economists call exorbitant privilege. I understand the phrase, but I prefer simpler language. It means you can run sloppier than others for longer because the world needs your liabilities more than you need their approval. That is a marvelous advantage. It is also a moral trap because the privilege lasts a long time. The issuer begins to assume it is a law of nature rather than a temporary historical arrangement. That mindset leads to overborrowing, underpricing of risk, and political laziness. Eventually, the rest of the world does not necessarily overthrow your system in one move. It simply starts building side doors, and every side door reduces the monopoly value of the front gate. This is why the gold buying matters so much. People who have been trained only in modern portfolio language tend to ask the wrong question about gold. They ask whether gold produces cash flow, whether gold compounds like a business, whether gold fits some spreadsheet ranking against equities. Those questions miss the role gold plays in periods when trust in political money and reserve structures starts being re-examined. Gold is not attractive in those periods because it is creative. It is attractive because it is inert. It cannot be printed by decree. It does not rely on a counterparty, S promise. It does not need a banking system, S permission to remain what it is. It sits outside the politics of any single state to a degree that paper claims never can. That is precisely why central banks buy it when they become less comfortable with the long-term neutrality of the existing order. They are not buying an income-producing enterprise. They are buying reserve insurance against political and monetary overreach. And when the people closest to the machinery are buying insurance, I pay attention. I also pay attention to debt itself, because debt does not merely grow, it changes the behavior of the borrower. A nation burdened with large debt and rising interest expense behaves differently from a nation with balance sheet flexibility. It becomes more sensitive to rates, more dependent on continued market confidence, more political about distribution, and more tempted to use inflation as a partial escape valve. Inflation does not need to become Weimar-style madness to do damage. It only needs to persist above expectations and above the pace at which wages, savings instruments, and tax brackets adjust. Then purchasing power is quietly transferred away from those who trust nominal claims and toward those who own scarce assets, productive systems, or pricing power. That is one of the oldest wealth transfer mechanisms ever invented. Most people imagine wealth transfer in the language of confiscation. They imagine property seized, bank accounts frozen, or a law passed against them personally. Those things happen in some eras. But the more common transfer is subtler. The measuring stick gets shorter, cash yields less than the true rise in living costs. Long-duration bonds lock investors into nominal returns while the real world reprices around them. Asset owners with leverage, hard assets, or strong businesses adjust faster than wage earners and savers holding paper. The public keeps seeing larger numbers on statements and concludes it is preserving wealth, when in fact it is merely keeping pace with a shrinking unit. A lot of people have trouble with this because they confuse nominal stability with real stability. A retirement account can rise in dollars and still lose ground in actual command over goods, services, energy, and shelter. A bond can pay exactly what it promised and still underperform life. A currency can remain the reserve currency while still being gradually less trustworthy than it used to be. These are not contradictions. They are how stage 4 begins to feel. I do not think the next world order will look like a neat swap from dollar to one perfect replacement. History is more complicated than that. The pound was not displaced in one ceremonial afternoon. The dollar's own ascent took time. Trust did not jump, it migrated. So when people say there is no alternative to the dollar, I hear a lazy argument. You do not need one flawless replacement to weaken the incumbent. You only need enough partial alternatives, enough bilateral workarounds, enough reserve diversification, enough commodity settlement flexibility, enough political distrust, and enough physical gold accumulation to reduce the old center's margin of inevitability. The loss of inevitability is the point. Once a system stops feeling inevitable, behavior changes before the headlines catch up. That does not mean the United States disappears. It does not mean the dollar becomes worthless. It does not mean New York stops being important. It means the world may move from singular dependence toward distributed hedging. And in that environment, the wealth impact on individuals can be enormous, even without a cinematic collapse. I have said for many years that a good investing life begins with understanding what you own, why you own it, and what could impair the logic under which you own it. The same principle applies here. If a person's entire financial life is denominated in one currency inside one political system, tied largely to long-duration claims that do poorly when inflation runs above expectations, then that person may be taking far more structural risk than he realizes. The risk is not that everything vanishes tomorrow. The risk is that his savings become an obedient victim of a long repricing. Meanwhile, those who own productive businesses with real pricing power, energy assets, farmland, commodities, or scarce stores of value may not even need to be geniuses. They only need to be positioned on the right side of the measuring stick problem. That is why every historical transition ends with the same emotional shock. People who thought they were cautious discover they were merely static. People who looked old-fashioned discover they were hedged. People who trusted official narratives over incentives find themselves paying for that trust in slow motion. Rome did not reward holders of debased coin. The Dutch transition did not reward complacency toward public debt and shifting trade power. The end of sterling primacy did not reward those who assumed imperial prestige could defeat arithmetic forever. And the coming adjustment in the dollar system, whether gradual or more abrupt, is unlikely to reward blind concentration in nominal claims that depend entirely on the continuation of old privileges. Now let me say something that matters. I am not telling anyone to become hysterical. Panic is simply another form of stupidity, the world's largest wealth. Shifts are rarely captured by one trade. They are captured by posture, by how you think about liquidity, by whether you mistake convenience for safety, by whether you understand the difference between productive assets and nominal claims, by whether you diversify geography, currency exposure, and sources of real value before stress makes such moves expensive, by whether you can hold some assets that are nobody else's promise, by whether you resist the temptation to measure your life only in a unit that policymakers have strong incentives to debase. In business, I like enterprises that can adjust a business with pricing power, low capital intensity, and essential demand can survive a great deal. The same is true of a family balance sheet. A household that owns productive assets, carries manageable obligations, and is not fully captive to one policy regime has far more endurance than one built entirely on paper confidence. What worries me most about the present moment is not merely the debt. It is the cultural attitude toward debt. Debt has stopped being treated as a trade-off and started being treated as a background condition. That is always dangerous. When a civilization no longer feels the moral weight of borrowing, it eventually loses the institutional habits that once protected the value of its obligations. The United States still has extraordinary strengths. I do not dismiss them. Its entrepreneurial class is real, its capital markets are real, its military reach is real, its universities, technology base, legal habits, and demographic advantages relative to some peers are real. But extraordinary strengths can finance extraordinary denial. The stronger the system, the longer it can postpone self-correction. That is why late-stage powers often look healthier than critics expect. Right up until the adjustment becomes harder to avoid, people tell themselves technology will save the system. I admire technology. I have invested around human ingenuity all my life, but technology solves many things and excuses many others. Productivity gains do not automatically cleanse a fiscal structure addicted to deficits. Artificial intelligence may change industries, labor markets, and margins, but it does not erase $30+ trillion of debt. Nor does it neutralize the strategic lesson other countries learned when reserves became a tool of statecraft. Technology can enrich a nation and still leave its reserve privilege on a weaker footing than before. That is why I separate innovation from monetary structure. A country can lead in software and still cheapen its unit. A country can dominate semiconductors and still overissue liabilities. A country can produce brilliant companies and still wear out the trust surrounding its government debt. The variables interact, but they are not identical. Another delusion that always appears near the late middle of these cycles is exceptionalism. Every dominant power tells itself that the old empires failed because they were corrupt or rigid or primitive or unable to innovate. The current power naturally is different. It is more enlightened, more efficient, more flexible, more necessary to the world. That narrative feels good because it allows people to keep enjoying privilege without feeling the need to defend it through discipline. I do not care for stories that flattering. I prefer to ask where the incentives point. Do incentives favor more borrowing or less? Do they favor honest taxation or deferred costs? Do they favor protecting the measuring stick or shaving it? Do they favor broad productive investment or asset inflation? Do they favor global trust in the neutrality of the reserve system or global hedging against its weaponization? The answers are not hard to see if you stop listening to speeches and start watching actions. And the actions are clear. Debt is high and still growing. Interest burdens are larger. Physical gold is being accumulated at a serious pace by central banks. Trade settlement is being diversified. Reserve managers are less naive about political risk. Soft claims are increasingly vulnerable to inflation, repricing, and credibility drift. None of this guarantees a calendar date for rupture, but it gives you a very strong clue about direction. The people who come through these transitions best are rarely the people with the loudest opinions. They are the people who quietly rebalanced before the crowd changed vocabulary. They own some real assets. They understood that a bond paying 4% in a world with 6% true inflation is not safety. They recognize that a savings account with a stable nominal balance may still be losing a race. The owner does not know he is running. They diversified before doing so became fashionable. They did not bet everything on catastrophe. But they also did not bet everything on permanence. That is the discipline I admire. If I were a young person today trying to protect and build wealth through a period like this, I would spend less time predicting headlines and more time understanding what kind of assets sit on which side of monetary change. Cash has a purpose. Liquidity matters, optionality matters, but large idle cash balances in a structurally debasing environment are not a strategy. They are a slowly melting asset that feels calm. Long-duration government bonds can also have a place, but treating them as automatically sacred when debt loads are large and inflation credibility is weaker than advertised strikes me as intellectually lazy. On the other hand, ownership in productive businesses with real pricing power, direct or indirect stakes in energy, agriculture, raw materials, select real assets. And some reserve insurance outside the paper system altogether can behave very differently when the measuring stick itself is under pressure. This is not exotic. It is common sense stretched over time. If the world needs more dollars to buy the same barrel of oil, the oil did not become magical. The dollar got smaller. If central banks are buying metal, they cannot print while retail savers keep extending duration in nominal claims. One of those groups is probably taking the history of wealth transitions more seriously than the other. If nations representing large shares of global population and output are exploring ways to settle trade without total dependence on one reserve architecture, then total dependence on that architecture is less prudent than it used to be. These are not conspiratorial observations. They are balance sheet observations. And balance sheets, unlike speeches, do not care about ideology. History does not repeat itself in clean textbook sequence, but it rhymes with great indifference to human ego. Every time a dominant financial order matures, the people living inside it struggle to imagine life after peak trust. That is understandable. We extrapolate from our own adulthood. We think the current arrangement is not just historically specific, but almost metaphysical. Yet the world's reserve asset has changed before. Financial capitals have shifted before. Trade systems have been rewritten before. Wealth has migrated across borders, classes, and asset types before. The old order always looks permanent until it starts being negotiated around. Then suddenly the public is reading formal recognition of a process that was already underway. I do not know the exact shape of the next decade. Anyone who claims to know precise timing is selling emotional certainty. But I do know this: when debt reaches extremes, when money creation becomes culturally normalized, when interest expense consumes fiscal room, when reserve assets are frozen for geopolitical reasons, when central banks buy gold in size, and when major nations start building alternatives, the prudent response is not to mock the pattern, it is to respect it. Respecting it does not mean hiding in a bunker. It means arranging your affairs so that you are not fully dependent on the continuation of a single monetary story. It means distinguishing between nominal claims and real command over scarce things. It means understanding that wealth is not the same as account balance. It means remembering that in every great wealth transfer, the winners were not always the most brilliant operators. Often they were simply the ones who understood the measuring stick was changing before the crowd did. That is the part most people miss. They assume wealth transfer means somebody outsmarted them with superior genius. Sometimes, more often, it means one group prepared while another group remained emotionally attached to yesterday's rules. The people who held Roman paper promises as the silver disappeared learned that lesson. The people who stayed fully attached to Dutch primacy after trade and debt dynamics had shifted learned it. The people who acted as though sterling prestige could substitute for industrial and fiscal reality learned it. And a great many people living under the dollar system may learn it too if they continue treating reserve privilege as a birthright rather than an asset that must be defended through restraint. I think of wealth as a claim on future choice. That is all it really is. Money is not important because of the numbers printed on it. It is important because it gives you room, time, and alternatives. When the unit itself weakens, or when the claims you own are too exposed to that weakening, your future choices shrink, even if your statements look larger. That is why I do not reduce this subject to gold or to panic or to anti-American slogans. It is bigger than that. It is about understanding what kind of world your savings are actually built for. Were they built for a continuation of peak dollar trust, peak bond sanctity, and endless low-cost deficits? Or were they built to survive a world where power becomes more distributed, reserves become more diversified, inflation stays more stubborn, and real assets matter more than policy promises? Those are two different portfolios. Those are two different philosophies. Those are two different futures. The wise response is not all or nothing. It is not selling civilization and burying coins in the backyard. It is not assuming every modern institution is fraudulent. And it is not assuming every old rule still protects you. The wise response is to accept that global wealth shifts are real, that they happen through mechanism, that the mechanism is visible before the public narrative adjusts, and that the most expensive mistake in such a period is passive concentration in the old measuring stick. If you want the whole thing in one sentence, it is this: the world is moving from unquestioned confidence toward conditional confidence, and conditional confidence always rewards hard assets, productive capacity, diversified exposure, and reserve insurance more than it rewards blind faith in nominal promises. That is the real meaning of the pattern. Not that tomorrow morning the old order disappears, but that the old order has already begun losing the right to be treated as the only serious game in town. Once you see that, you stop asking the childish question, will everything collapse? You start asking the adult question, what should I own if credibility itself is being repriced? That is the question I would want my children to ask. That is the question I would want any serious saver to ask. And that is the question the largest institutions in the world are already answering with their actions. They are not telling you with speeches. They are telling you with purchases, reserves, settlement experiments, and hedges. The pattern is not hidden. It is simply easier to ignore than to act on. But history has never been gentle with people who confuse ease of ignoring a pattern with absence of a pattern. The transfer begins before the public feels it. Then the public feels it before it can name it. Then the experts finally name it after much of the transfer has already occurred. I would rather be early and thoughtful than late and certain. That has served me well in markets. It serves just as well in empires.